With recent inflation data coming in hotter than expectations, the market's at a very important spot, and the bulls are going to need to make a stand if this rally is going to continue. What's up, guys? It's Brandon from Amphibian Trading. As always, make sure you hit that like and subscribe button so you don't miss any future updates. Really quick, I just wanted to mention that I put a feeler out on Twitter to see if there's any interest about having a dedicated section of my Substack for PineScript, going over some of the basics as well as the logic behind the indicators I've created. So if that's something you'd like to see, let me know in the comments, and without any further ado, let's jump into this week's action. So let's start by taking a look at the NASDAQ, which has had a rough few weeks, falling about 7.5% since the start of the month. Now, while this pullback in a lot of individual names has been harsher, it doesn't surprise me that the NASDAQ came back down and tested that 200-day moving average. Since the bear market started, we haven't been above the 200-day or let alone touched it until last month. So the idea that we would just rip through it the first time, never look back, never back and fill just seemed silly to me. Let's go back and look at some other bear markets starting in the early 1990s. Okay, so here is the early 90s. You can see the bear market starts here. We come down through the 200-day moving average. We then push back above it before we come back down through it. We live under it for a little bit, and then we push above the 200-day moving average. We stay above it for a little bit of time before once again we crash through it. And then finally on this third attempt is when we get through the 200-day moving average and we continue higher. Okay, so let's look now at 2000 to 2003. You can see the bear market starts here, crashes down through that 200-day moving average before we get back above it for a little bit, and then we fall back through it. We get back above it again. Then we crash through it. We stay down there for a while. We go ahead, we get back through it again at this period, come back down through it one more time. Now let's zoom in a little bit. We test it here, and then finally on this third time, we get through it, we test it again one more time before we continue pushing higher. All right, lastly, let's look at 2008 and 2009. Here we have the start of the bear market. We come down, we hit that 200-day moving average, we bounce there, and then we eventually push down through it. We then come up, we test it, we get up above it before we crash down through it. Once again, we come back, we at least test it, and then we crash through it again. And then finally here at the bottom, let's go ahead, we'll zoom in, we get above it, we come back down below it, we get above it, we come back down below it, and then finally when we get above it this time, we continue higher. So again, while it's no fun to have the markets pull back, it does make sense that we at least come back down and test that 200-day moving average. Let's go ahead now and throw our fibs on from the low to the high of this latest rally. Looking at these, we have the 50% retracement level right below price now, and that 50-day moving average should be at about that same level early next week. This level also lines up well with these two peaks from October, so if the bulls are going to make a stand, I would expect to see it around this area. Let's go ahead now and look at some potential risks for the market. First, the dollar's continuing its uptrend since the start of February. All of the shorter term moving averages, the 8, the 21 exponential, and the 50-day simple are bullishly stacked, which is not what the equity bulls want to see. This could potentially run into resistance at its 200-day moving average above, however. Next up is the 2-year yield, which is sitting right near its highs from November, with all of its moving averages also bullishly stacked. One positive divergence here is the price of the NASDAQ is much higher than it was back in November when the 2-year yield made that high. So we'll have to wait and see how this one plays out. Next, if we go over to the 10-year yield, something that sticks out to me here is this perfect double bottom base. I mean, if this was a chart pattern on a stock, I would be all over it. The moving averages here are also stacked bullishly, so unless something changes or we start getting some favorable data again, this does look like it wants to go higher. And lastly, let's take a look at the VIX. While the VIX isn't quite the same as a stock, it is starting to show higher highs and higher lows, and it's also starting to see its own moving averages also align bullishly. So there are definitely some headwinds for the market, but there is that key area that we'll be looking for the bulls to step in, and we also want to see the 200-day moving average eventually flip to support. Thank you for watching. If you enjoyed this video or found any of the information useful, please go ahead and hit that like and subscribe button so you don't miss any future updates.